Hello, I'm Juliet Schooling-Latter, and I'm here with James Mahon, manager of elite-rated Church House Tenax Absolute Return Strategies. James, you're coming up for the 10-year anniversary of your fund. Can you give us a couple of highlights over the decade? Are the people who've stayed invested with you throughout that time?
Yes, I'm delighted to say that our original seed investor is still invested and has very kindly recently given us quite a lot more money. So that's very satisfactory, very nice. And the fund has grown quite significantly over the period, so very happy with that. Highlights, I think probably at the start, really. Having launched in November 2007, we were of course just in time for the meltdown of 2008. So that whole 2008 period was undoubtedly a highlight, and timing the entry into assets in 2008 would have been probably, I'm not sure if exciting is the word, but the most interesting period. And then, of course, from the monetary perspective, 2009 was the most satisfactory because we had managed to acquire the right assets. Because obviously in 2008 there was such a meltdown. Good assets were being thrown out with the bad assets.
Yes, indeed. Well, yes, that brings me on to my next question, which is that we've seen the first interest rate rise in your time managing the fund, and so what sort of impact will a sort of rising interest rate cycle have on your fund, and how will you position it?
We are positioned for a rise in rates, in that we have a very significant portion of floating rate notes, and quietly the interbank rate, so the LIBOR rate, has already moved up from around 25 basis points 2 or 3 months ago, up over 50 basis points now. So we're already seeing a benefit for our floating rate notebook. And where we have fixed interest holdings, they are very much at the short end of the market. And we have hedges in place as well. So we're positioned for the risk of further rate rises.
Right. So you've got things in place to ensure the portfolio against inflation. Have you as well as sort of rising interest rates, or do you think it's just a temporary move?
I think the move in inflation is probably going to persist rather longer than the bank might like. I think it is likely to hang around. And my suspicion is that the bank will have to start moving rates more quickly than they indicated when they put rates up this month, sorry. So in terms of inflation hedges, we're not holding any index-linked instruments simply because they're too expensive. They very much reflect potential moves. So our moves are the moves in floating rate paper and in the short end of the market. So clearly, if we get an increase in inflation, increase in rates, it's the bond markets that are going to feel the pain particularly.
Thank you very much, James.